Hey there, I welcome you again in our chapter 5 of this course on option trading strategies. In the previous chapter, we have talked about a strategy of bear put spread, which works or which is to be used when you're having expectation of moderate bearishness in the market. Now, in this chapter, I'll talk about another strategy which can be used when you're having similar expectation of moderate bearishness, but the implementation is completely different. In the previous strategy, we used put option. In this chapter strategy, we'll be using call option. And also, an interesting difference is that in that strategy of the previous chapter, initially you had to spend more than what you received, but in this strategy, you'll be receiving more than what you spend in the market. So that is the difference between the two strategies. So let us begin right with the implementation of the strategy because we have understood the premises as to when to use this strategy. So under the strategy of bear call spread, you have two option position running. As you can understood, there'll be call option and you're expecting bearishness. So under the first leg, you buy one out of money call option. Always told you when you have a strategy with two legs and one leg is sell, always execute the buy leg first because it reduces the margin required. And the second leg would be you sell or write one at the money call option. Those are two legs under the strategy of bear call spread. So when you're writing at the money option, you'll be receiving more premium than what you give for buying an out of money call option. So that's how the implementation of this strategy works. Now let's understand the payoff of this strategy from a simple payoff chart. So again, you go to the strategy builder here and you choose the strategy of bear call spread. And as the market is trading at 19,742, so at the money option is what you write and out of money option is what you buy. And I choose the next expiry and I execute this strategy on the market. Now, as you can see, the payoff chart again, the loss and profit both are capped. Now, this is the interesting thing about these strategies. These strategies give you the option to go multiple legs. I've been saying this again and again because I am talking about these strategies which have potential to go maybe multiple 100 lots if you want to execute this strategy. So if the market falls, which is what you're expecting, you would be making money and the maximum profit is capped in the strategy. Even though the market goes against your views and it starts going up, because you have also bought one out of money call option, your loss will also be capped under the strategy. So what will be the point of break even in this strategy? Remember, you have sold an at the money call option, bought an out of money call option. So there is a net inflow. So what you do, you take at the money strike price plus you add to that the net inflow, which in this case, as you can see, for writing you got 146 units and for buying you paid 96 units. So there's an inflow of 50 units. So 19,750 is the at the money strike price. You add 50 units to it. So 19,800 becomes your break-even point in this strategy. So as long as the market is below that, you would not be losing money in this strategy. Once the market starts going above that is when you would lose some money, but that is also capped on the upside under the strategy of bear call spread. So that is it from in this chapter where we learned about another strategy which can be used when you have a moderately bearish view in the market. So in the chapter 4, we learned about the strategy of bear put spread when there was initial outflow because you bought at the money put option and sold out of money put option. In this chapter, we learned about the strategy of bear call spread where you sold at the money call option and bought out of money call option, which means there was a net inflow. In the next chapter, we'll talk about another strategy which can be used in the market and we'll also see how do we make better implementation of the strategy. So see you there.